All right, thank you, Mark, and greetings, everyone. It is exciting to see so many people here. Like Ken said, we've hit a record tonight, and that's great. What I am presenting today, as Mark said in the agenda, is TEVA pharmaceutical, and I will introduce it by letting you know how I came up with that as my pick. The first thing that I did was I ran a stock screen. You see the results here from my stock search screen. It's on the screen. The criteria are at the bottom. PAR of 12, which was 5 percentage points over my PAR. Excellent quality, that being greater than 65. With my PAR running significantly under 10%, I want to tighten my financial strength, so I used 80% there. And then I was looking for reasonably stable companies on a not volatile from an earnings standpoint, and plugged in 60%. And you can see that TEVA came out on top of that screen with projected annual return of 18.9%, or PAR of 18.9. You'll see a fair number of familiar companies on the screen as well, several of which are in the portfolio and have been presented in the last few months or have otherwise been discussed. Okay, next screen. As I did last month, I also took a look at the existing roundtable portfolios sorted by PAR. You've seen this slide with the exception of the TEVA line earlier in Mark's introduction. You can see last month, I believe BioReference was at the top. It may have been trailing Jean Penn, perhaps, and it was my pick. You can see that TEVA comes in second by PAR on our existing portfolio, and with all due deference to Ken and Chinese pigs, I decided that I would diversify our portfolio a little bit.
Oink, oink.
Hey, we in the South love to pull pork too, but I decided we would go with pharmaceuticals this month, and so that's how I came up with TEVA. Next slide. One other thing I mentioned those as my exploration, or the way that I went out to find a potential company. One other thing, I believe Ken also mentioned this last month regarding his selection, but one of the things that Mark and us are doing in our manifest looking is tracking value lines, not just the value line median annual price appreciation, but also tracking for all of the stocks that they hold the low potential return over the next 3 to 5 years, and seeing if that might be an even better approximation for the market return when you look at all 1,700 stocks. I also like doing that on an individual stock basis, and if their low return is within my goals, again, that says this stock may be something to take a look at. As you can see, value line saying a potential of 21%, which is just a little above manifest's 18.9%. So certainly it looks intriguing to me. Next. One of the things that I like about TEVA is that management sets out pretty clearly their long-range goals. They do a strategic review every couple of years. The last one they did was in January of 2010, and they took a look at where they were then and established some targets for 5 years out, which was 2015 at the time. Coincidentally, since we're just at the end of their fiscal 2010, having been finished in December of last year, we're still, 2015 happens to be our 5-year goal too, so it just kind of makes some of the tracking convenient. But in any event, Here were their goals: revenues of 31 billion, net income of 6.8 billion, net profitability of 22%. That revenue figure, I don't remember if I've got a slide, but I'll go ahead and mention, is a compound growth rate of 14% from their 2010 figure. Yes, we do have that slide right here, and you can see they say that they're pretty much on track from 2009 through 2010, where they're looking at this current fiscal year, 2011 on out to 2015. The next slide shows their earnings. And you can see they're shooting for about 13.5. Keep in the back of your mind that $7.16 as we move forward. Okay, next slide. One of the key strategies that TEVA has followed throughout their history, and you can see here just a map of earnings and sales over since 1995 with an overlay of their significant acquisitions. They do a lot of growing by acquisition. I have not seen exact figures consistently given, but roughly 40% or so of their historical growth appears to me, at least over the last 3 to 5 years, to have been from acquisitions. Those of you who maybe knew Barr Laboratories, a large pharmaceutical company in the United States, you see they acquired Barr Labs in 2008, which has a lot to do with their strategy that we may discuss a little bit in a few minutes on growth. Next slide. I'll go ahead and mention at this point in time, one of the big challenges facing TEVA is the Copaxone, which is one of their proprietary drugs. TEVA is a unique company. They're the #1 generic manufacturer in the world, but they're also a significant branded pharmaceutical company as well. They have drugs that are patent protected that they have developed through their either acquisition or their own R&D. The largest one of those right now is called Copaxone, which is a multiple sclerosis treatment. Current sales of about a little over $3 billion, and while TEVA does not release publicly the profitability, Morningstar estimates about half of their net profit comes from that drug. In any event, that drug has been pretty much the market leader in exclusive MS treatment for a number of years, but is beginning to face some competition from other drugs, and also will be going off patent in 2014. So there is major concern in the market over what TEVA will do once Copaxone both faces competition as well as coming off patent. They're seeking to address that through developing other drugs in that particular area, as well as other that particular area being multiple sclerosis, which they've developed an expertise in, as well as other branded drugs, as well as continuing to grow their generic business. But one of the things that they've announced in the last month is another new area, which is a partnership with Procter & Gamble, and this is just the intro slide from their investor presentation, creating a new business model in consumer health care, and I've grabbed a couple of highlights from that just to talk about it. Next slide. Essentially, they're seeking to grow their business geographically. This is outside of North America, is where this partnership will have its largest impact, increasing access to over-the-counter medicines. Next. Here's just a description as to what the agreement is. A joint venture outside of, for OTC, over-the-counter businesses outside North America. TEVA will be manufacturing, and then they'll also seek to develop new products as well. Next slide. They see the consumer healthcare market as $200 billion globally, and the megatrends that are impacting it, you can see: aging population, increased focus on wellness, and consumer involvement. Next slide. Here is a little bit of a busy slide, but essentially what they see as the synergies or the impact of the partnership. They essentially, in other slides that I didn't bring out here, say P&G is a master marketer, in fact is the world's #1 advertiser, and TEVA has the expertise in drug development and so forth, so they're going to work together. And again, this is largely outside of outside of the United States, some in South America. So it would be outside North America, I guess, if it's South America. But there will be some North American, as you saw back on the slide, as far as on research and development and new product. But the over-the-counter emphasis is in their international markets. Next slide. The other strength that they do mention, in addition to those listed on the previous slide, is that Procter & Gamble's has excellent inroads into grocery stores and mass marketers. TEVA has pharmacy. So again, combining those two strengths, they think can assist the marketing. Next slide. The reason that I mentioned this and took a little bit of time and led off with the Copaxone introduction, remember that is a little over $3 billion right now and will be subject to some attack. Currently, they see the value of this joint venture business at $1 billion, growing to $4 billion in the next few years. So certainly is a way of addressing some of that potential revenue shortfall. Next slide. That's just kind of a quick overview of TEVA, some of its challenges, some of its businesses. A couple of numbers that I'll throw out to you that are not on the slides, and then we'll look at my analysis, and I'll turn the microphone over to Hugh, I guess, is next. But a couple of things. Roughly 70% of their current business is generic drugs. They expect that to remain about the same between now and 2015, with 70% being generic, 30% being branded. They have the expertise in branded drugs, as I mentioned, this Copaxone multiple sclerosis treatment. They also have a significant women's health area, and they expect both of those to continue to grow. Currently, about 62% of their business is North American. They do expect to expand internationally faster than North America over the next 5 years and cut that percentage to about 48%, 50%. So they'll be looking to go a little bit more international, but keeping the mix of generic and branded drugs about the same. And the one last thing that I'll just mention, I mentioned the Barr Laboratories acquisition. One of TEVA's business models, and I don't know whether I should love this or hate this as a lawyer, it doesn't necessarily give me any business, but they do actually have litigation as part of their business strategy. Specifically, what they do is they look for drug patents that they feel are subject to challenge and will file challenges against the patents to get them off patent earlier. That obviously gives them the opportunity to market their generic sooner than would otherwise be the case. The other reason that TEVA does this is that if they are successful in challenging a patent under the law, the company that successfully challenges a patent has a 180-day or 6-month exclusivity period where they are the only generic manufacturer allowed to market against the brand name drug. So essentially, if a generic manufacturer successfully challenges a patent, they get a head start in marketing their generic, which gives them somewhat of an advantage as well. Ironically, now TEVA is finding itself subject to some of those challenges, since they are also in the branded area. All right, these next two slides just give you the history and then my analysis. I'm looking at annual growth rate of sales of 14%. That is the company's goal. It's a little below their historical. Morningstar finds that to be a achievable goal. Interestingly, if you take a look at Valueline's sales projection over the next 3 to 5 years is only 7.7%, but remember, Valueline does not ordinarily take mergers and acquisitions, which is a major part of TEVA's strategy, into account. The next variable is the margin. Remember, TEVA's goal for net margin is 22%. I found about 21.3 to be reasonable, and plugged that in as my judgment. Here is the place that I part company with both Valueline and Manifest. Most significantly is on shares outstanding. Currently outstanding is 921 million. Valueline's projecting, I think, 907. If I recall, Manifest is in between the 921 and the 907. However, if they're going to grow by acquisition, historically they do that through issuing shares, at least partially. And I just simply took the average annual increase in shares over the last 5 years, projected that out over the next 5 years, and that gives me the 1.1 billion roughly that I've stuck in there. Gives me an earnings per share figure of 5.98. Remember, the company was projecting 7.62, I believe, so we're well under their goals, but certainly appears reasonable. I found a average PE of 15 to be reasonable, and then that leads to the stock price of 89.7. At a 20% payout, the dividend yield would be about 1.3% for a par of 15.7, which is well above 5 over my par, which is 12% right now. So that's my pick.
Sounds good. Have you ever actually trended shares outstanding for a company like this and come to a number during your studies?
I have done it a few times, but not that frequently. Usually when I have done that, Mark, is for serial acquirers like this.
Yeah, it sounds like something we might want to take a look at. We've used it for companies like Danaher, and it's something I don't think we have deployed in this case. And you're right, the Valueline number is not, possibly is not reflective of the future shares outstanding.